Okay, I'll check that you guys can hear all right, and then we'll get started. So, how's sound over here? You okay for sound? Good. And you guys at the back there, you okay for sound? Good. You guys, you're fine? Yeah? You guys okay? All right. Looks like it's all good. Okay, so on Tuesday, the first online quiz will become available. So in terms of the Learn site, in the very top section here, you'll see this section here, which currently, from your point of view, there's nothing in the online quizzes. But if you switch back to me, you'll see that there's one coming. When it comes, here it comes. So I'll scroll down to where that is. So there's the first online quiz there. It's going to become available on Tuesday morning at 6 a.m. And the material covered in that particular quiz will be from the overview. That's the first topic through to the end of the Reserve Bank, which is the one we finished on Wednesday. So that's going to be the material that's going to be covered. There will be 20 questions in there, covering those topics. You'll have a maximum of half an hour to do the quiz. And at the end of that half hour, there's what the software calls a grace period of 10 minutes, which basically means you can review your answers, but you can't answer any more. But then at the end, you have to click on that submit button to get credit for the test. So it doesn't automatically submit it at the end of the half hour. You have to actually click that button to submit it. And then, of course, it'll give you a mark. You are allowed to do the quiz twice if you want to, but there is a required 2-day gap between your first and second attempts. So if you want to do it twice, that means you have to sort of do your first one early enough to give you enough time to have your 2-day gap and then come back and have your second attempt, because the quiz will close off at 6 p.m. on Friday. So that's when it's going to close off. So it'll be open from 6 a.m. Tuesday through to 6 p.m. on Friday. That's when it'll be open. And if you do it twice, then whichever one of those two is the higher score, that becomes the score for your test, for your online quiz. And in terms of the overall mark, that will be worth 2% of the final grade. So it's quite small. Are there any questions on that? Yes, go ahead. Oh, yes, certainly it is. Yeah, they're all multi-choice, and they'll all appear on one page, so all 20 will be, you just have to scroll up and down to see them all. And I think pretty much every one of them has four options. So basically, you'll have a question and 4 choices that you can pick from. Yes. There's 20. There's 20 questions and half an hour for the whole quiz. So it's on average a minute and a half per question. And the reason for the 2-day gap, as I explained in the very first lecture, is that what the educational people call distributed practice is it gives you a chance to actually try it, see what sort of score you get, figure out where you may have gaps in your knowledge and weaknesses, go do some more study, and hopefully come back and get a better grade after a couple of days. So, any other questions on it? Okay, that's fine. So we'll start with today's topic. So today we start on this topic of what they call the level of interest rates. In the previous topic on the Reserve Bank, we said that we spoke about their monetary policy, how they have influence on one interest rate in the economy. And one interest rate only, and that's that overnight interbank market. And they can pretty well control that by manipulating supply. Now, everything else in the economy and every other interest rate in the economy is outside their control. And we look at some of the factors in this section about what actually goes into setting an interest rate. So this is the outline. We'll have some introduction. Then we'll talk about what interest rates actually are and their purpose. Talk about one particular theory, the loanable funds theory of interest rates, go on to the Fisher effect, which is try to take account of inflation, and then forecasting. So interest rates, if you ever listen to a financial report, say on television or radio, or you read one, somewhere in there, there'll be probably at least one or maybe more than one interest rate. One of the common ones you hear in New Zealand is the reporting of the 90-day bank bill. And the reason they report that particular interest rate is that's a key interest rate when they set the mortgage rate for the people who want to borrow money for the mortgages. And interest rates do take a lot of people take a lot of interest in them, and there's a list of people who you might get some commentary from. And the quality of the commentary varies a lot with who's actually making the commentary. So if you get, like, say, for example, in terms of a professional economist, something like a bank economist coming out and making a statement of some sort, usually in response to a question from a reporter of some sort, often what they have to say is pretty informative, because they're actually the economists for the banks, and this is their business. The other ones, financial journalists, highly variable depending on who's writing. Industry groups is basically putting their point of view about what should happen. Typically, they want better rates for themselves. Sometimes people in Parliament make comments, can be very self-serving, may not be very informative. But the last one that you may get very informative comments from is people who are public servants, particularly people from either the Treasury or the Reserve Bank, and seeing how management of interest rates is part of the Reserve Bank's job. Comments by them are often highly informative. So what do? They actually directly affect the value of most securities in the money markets, and we'll come to how that happens in basically Chapter 6. The interest rates, they also influence the exchange rates, and the key thing there is the differential between your interest rate in your country and your trading partners. So if your interest rates are higher than your trading partners, what that tends to do is drive your exchange rate up relative to them. So if you are raising your interest rates, say a central bank is pushing your interest rates up, that will tend to make the exchange rate rise relative to your trading partners. When we say what is an interest rate in one sense, if you go out into some sort of market and you look at interest rates, that's what we call the nominal rate. Now what we're going to do in this section, in this part of the course, is start to pick apart that single interest rate and ask what are all the factors that go into figuring out what's the right rate to charge. So if you went to a bank and you saw an interest rate of 4%, they don't explain how they came to that decision, that 4% is right. But we're going to look at a whole bunch of factors which may influence it. The other thing about interest rates, in the fifth point there is that, in the fourth point, that they're not static. Because we talk about, an equilibrium rate, and if you've done some high school chemistry, when you talk about equilibrium in chemistry, that's when everything stops. The reaction's over, everything stops. But we don't mean that when we talk about equilibrium rates in these types of markets. So here's a graph of the 90-day bank bill just over the last year, and you can see it's moved around quite a bit. This is 2.57 up here. It's dropped away, and the most recent one they have in this graph here is fairly close to about 2%. So it's moved around a lot. Now, when somebody would look like that, if you say, or a chemist, and you look at that and say, oh, things were not in equilibrium. But when we talk about equilibrium in both economics and finance, every point on that graph all the way along is an equilibrium rate. And we'll come to how we actually define an equilibrium rate. So when we say that the interest rates are dynamic, they move around all the time, but basically at every point in time, they are what we consider to be an equilibrium rate. Now, the interest rates themselves, they directly affect the actions. Now, in terms of governments, probably not a great deal. Businesses, it definitely affects them because, if they're borrowing to expand their business, they want ultimately to be profitable. And of course, it affects individuals as well, both in terms of the incentive to save or the incentive to borrow. And in terms of what the Reserve Bank does, in terms of its management of the economy, it simply tries to manage the behavior in the economy by moving, in their case, only one interest rate around, but they hope that interest rate flows through the rest of the economy and directly influences people's behaviors. Now, there's a lot of things to consider, and if you're going to set an interest rate, in one sense, they're all set by supply and demand. And so there's some aggregate supply, there's some aggregate demand, and then there's some equilibrium rate associated with that. But within that, the people who are doing the supplying of the funds and those who are considering borrowing, they have a whole lot of stuff that they need to consider. On the supply side, they need to consider, a lot of things in terms of ultimately, what interest rate do I want? And of course, on the other side, the borrowers, they can consider a whole lot of stuff and ultimately come up with an answer to the question, what can I actually afford? Now, the top one, the inflation, has become an issue that used not to plague the world anywhere near as much as it does today. So here's a graph of 800 years of inflation data. Now, not all the countries on this chart here are actually here, but we've got 800 years of data for Great Britain. And you can see through most of the period, like the first 700 years up to 1909, inflation was not a big problem. And so if you were setting an interest rate in that period, you most of the time you could completely ignore the effect of inflation. And then, lo and behold, there was some magic. Well, it wasn't magic. It was basically, they went off the gold standard. And they started making money the way we make it today. You simply create it out of nothing. You can simply create as much as you want. And if you create far too much, like Germany did, you can get vast amounts of inflation. Because this is a logarithmic scale. So this is 1. And this up here is 10 trillion. Okay, so we're not just going up linearly here. We're going up logarithmically, step of 10 every time we got one of these notches. And that's Germany. Okay, so basically for a short period of time, they cranked out far too much money. There was absolutely no limits to the amount of money we can create in the system we have today. And they got inflation probably never seen before. But even if you take developed economies, Switzerland's down here at the bottom. That one at the top, I think, is Italy. It's kind of hard to tell. It's not Germany. But you can see, even in ones that didn't have this hyperinflation period, they've had systematic inflation for a long time. And if you think back to the section we just covered, both in terms of Australia and New Zealand and many other countries throughout the world, there is this legal mandate from the government to systematically depreciate the value of the currency over time. And for us, it's 1 to 3%. And over a long period of time, say 40 years or so, that makes a huge difference to the value of currency. And it shows up in that sort of stuff there, that the value of the currency is simply being systematically eroded away, deliberate action on the part of the Reserve Bank in response to the mandate that is received from the government. And of course, if you're an investor, this is affecting your purchasing power, and so you want to take account of this when you're figuring out what your interest rate should be. One of those places to start at is what we call the real rate, and that would be the interest rate that would exist if there's no inflation. And another way of looking at that is, you're saving when you're investing because you want to increase your purchasing power, and the real rate is how much increase in purchasing power you want. Then there's a whole lot of risk factors. If we strike a risk factor as investors, we have to basically figure out how much it's likely to cost us in a statistical sense, and then we have to add that somehow into some sort of premium. So things like default risk, that we may not get our money back, liquidity risk, that we may not be able to sell our security when we want to. We have to consider those. And there's sometimes other things like special provisions. Some places in the world, not so much here. Some types of securities are not taxed or taxed at a different rate, whether they have these things called convertible options in them, which we'll come to in a later section. And then the final one, there's the time to maturity. Basically, the longer your money is going to be tied up, basically the higher the return is that you want. And you have to consider all these things before you eventually come to the point where you decide, either as a borrower or as a lender, what interest rate you actually want. So there are just absolutely thousands of interest rates out there of all shapes and sizes doing all sorts of things. And if you, say, go into the indirect market, and here's some data I picked up this morning. This is just a few interest rates. There's 15 interest rates off the ANZ website. And these are their term deposit rates. And they range from the 30 days here at 0.5% up to 5 years at 4.2%. And so every last one of those is an interest rate. And you can see they vary a lot depending on how long you want to tie your money up for. On the other side, if you want to borrow, this is just their mortgage rates for their mortgages, fixed rates here. Again, they vary. 6 months, 4.99. Why do they say 5? Anyway, up to 5 years, 5.85%. So at each time until they get a chance to review your interest rate and change it, there's a different interest rate associated with them. So in the indirect market, there is essentially a gap between the borrowing rate and the lending rate. Let's take an example here. Let's take 2 years. So this is your term deposit. So this would be how the bank would get 2-year money, and they would pay 3.8%. They would turn around and they would lend it out here 2 years. We'll take this one here, 5.29%. So there's approximately 1.5% difference there between the money, what they're paying for their money, and what they're earning if they make a loan in terms of a mortgage. And the difference between those two things is basically their gross profit. And out of that, of course, they have to pay the expenses on their running their business, and hopefully they end up with some net profit as well. But when we go to the direct market, each security has its own interest rate. And when we come to the money market section and the bond market section, we call these particular interest rates yield. But basically, every single security out there has its own interest rate that is set, by supply and demand at the time that it's issued. But once it's transferred to the secondary market, the interest rate can change on a daily basis there. And so there are quite literally thousands of different interest rates depending on the purpose of that interest rate within the economy. So, coming up to our first set of questions here. What is an interest rate? And then we're going to ask the second question about this allocative function in the economy. So, when we're talking about an interest rate, what is it? What is it? And there's several ways of looking at it. Any ideas about how you can look at what an interest rate actually is? Yeah, go ahead. Yeah, I'll take you second. I'll take you first. Yeah. Cost of borrowing. Yeah, that's cost of borrowing. Yeah, anything else? Okay, a rate charged for the use of money. Yeah, that's yep. Okay, so that's another way of looking at it, is that if you're going to defer your consumption, you're going to save your money and invest it, this is the reward for doing that. And a very important thing when we've got inflation in there is that it's not about standing still. Okay, so it's not about offsetting. This is not about offsetting the effects of inflation. This is actually about growing your purchasing power by waiting in terms of when you're going to use it. Any other ideas? Yeah, go ahead. So that's from a borrower's point of view. Is that right? Or it is? Can be both? Okay. Okay, so from a borrower's point of view, in one sense, they have to be able to pay for this, right? Okay, so that's an important point. That if a borrower is going to get the money, they got to pay for it. Okay. Okay, so there's several other things. No, I think we got most of them. So let's see. Did we miss anything? Okay, at its most basic, it's simply a price. And it's a rental price. It's interesting. It's interesting. If you go back far enough in history, they used to think that you shouldn't do this, shouldn't actually charge interest on money. And one of the places where it's actually explained as to why you shouldn't charge interest on money was the Greek philosopher Aristotle. And he could understand that if you borrowed a bag of wheat from someone to plant your field, that at the end of the growing season you would have lots more wheat, and you could pay, maybe 2 bags of wheat back for the borrowing. But he didn't, shall I say, I'm not sure whether he didn't understand or didn't believe. He didn't believe that by borrowing money you could actually grow money. And that's why he thought you shouldn't charge interest. But anyway, in one sense, it's a rent. Said that bit about the penalty. We said the penalty, we said the reward. When you look at the interest rates in the market, they're always expressed as an annual rate, independent of how long that interest rate applies for, or when we come to compounding, how many times per year it's compounding. Now, we've talked about, in the first section, about our wish list for what we want our financial markets to do. And one of the things we want them to be is allocationally efficient. So how does an interest rate serve an allocative function in an economy? Yeah, go ahead. Take you first.
Well, the higher return you can generate with the money, the higher interest you will be able to offer to people for the use of their money. So that in that way, the most profitable projects will have the greatest access to funds, so funds will get located to their best use.
Okay, so to summarize that point there, good point is that for a borrower, they have to pay for this. And once they get that money, they'll probably do something with it. And it depends very, very strongly on their ability to generate a return by borrowing this money. And basically, the higher the return that they can generate, the more they're able to pay. Fair comment? That summarizes well? Okay, do you have another point?
Yeah, I was about to say it's very similar to any other commodity that you actually would study in economics in terms of you've got to actually have an interest rate that is high enough to actually get the people with the capital, so the SSUs, to actually give up their money for somebody else to use. But it's got to be low enough for the DSUs, the people that want to borrow the money, for them to actually get, for them to actually want to borrow that money. And so, yeah, you'll get an equilibrium interest rate where the price that the borrowers want to borrow at and the price that lenders want to lend at.
Okay, so there's two sides to that. One is what can the borrower pay for that money, and then the interest rate, in another sense, works on the saver and investor because they want that interest rate to be high enough to make it worthwhile them actually saving and investing that money. So it works on both sides. So in one sense, there's only a finite amount of capital around, and basically, in terms of allocating it, the interest rate works between the savers, and basically the higher the interest rate is, the more likely we're going to get people saving. And particularly on the borrowing side, the people who can pay the most are the ones that are most likely to get the money. And the reason they can pay the most is because the use that they have for it is high value use. So that's how it serves in allocating this finite amount of capital. So that okay. Any question on that before we go to the next batch of questions? Okay, so thinking about this real rate of interest. Now, this is the one that would apply if there was no inflation. Now, these days, we always have inflation, and all our interest rates have something else on top. But thinking about the real rate of inflation, not real rate of interest, in one sense, this is how much you want to grow your purchasing power by for waiting. How would that actually get determined? How would that be determined? What can be paid? Yeah, go ahead.
The money supply.
The money supply, and how would that do it?
It's kind of like supply and demand. So if you want to change the real interest, you manipulate the supply.
Well, I think I understand what you're saying, but I think you're actually not answering that question. I mean, in one sense, what you're talking about is having this balance between the supply and demand. That gives you your nominal rate. Now, within that, and we'll particularly look at this when we get to the Fisher equation, there is a component which is how much extra purchasing power you want as a saver for waiting, and also how much real purchasing power are you paying back in terms of interest from the borrower's point of view. So okay, so we haven't answered the question yet. How would we figure out what this rate should be? Yeah, go ahead. Okay, so that's how you calculate it. If you could get the expected inflation and normal rate, you could actually back it out and calculate it, couldn't you?
The real interest rate will be the actual increase in the value, or the actual change in the value of the money.
Okay, so the actual purchasing power change. Yep, go ahead. Well, that gives you your nominal rate, your balance between your supply and demand. Okay, so I'm missing the mark here a little bit, so we'll just flip over the whole thing here. So when you think about this real interest rate, now, in our world, we always have inflation to deal with. And that makes dealing with the real rate a little bit complicated because when you go and look at a nominal rate, you have more than just the real rate in there. Now, one of the things about this is how on earth are we going to figure out, what this is? Let's see, where are we going to go? Oops, did I take it out? Actually, oh gosh, I think I've shifted it. Okay, the real, maybe I moved this more than I thought I did. The basic thing there is that the real rate that can be charged depends very strongly on what real rate of return the borrowers can generate. So if you think of a business, they're running their business and they want to expand that business, and the question to them is, if we go out and borrow, how much extra return can we get on our investment? So let's say, for example, it's a power company, and they're going to build some sort of new power generation facility, and they ask themselves, what real rate of return are we going to get on our power generation facility? And let's say, for example, they can just generate 10% off. They build the thing, and they can generate 10% return from themselves. Now, that level of return basically fixes what they can pay. And, with power generation, you can probably change your prices with inflation, but you normally can't push up the real rate in there. So whatever the productive capacity of the economy is in terms of generating a real growth, that tends to determine what this real rate of interest actually is. And the point there that is usually not observable, that's true because we've got other factors in there. We've got risk factors, and particularly we've got inflation to deal with. But when economists look at it, typically they assume it's around 3%. Now, when we come to one of the later sections and we talk about inflation-adjusted bonds, the real rate actually becomes visible. Now, one thing that people do get confused about is that there's this other term that we talk about, which we call the realized rate of return. Yeah, that one there. It sounds very similar, but this one is the one that you have at the end of your investment when you look back and you know how much you earned, whether there are any defaults, what happened to inflation, all that sort of stuff. Okay, so there's my point there. This one. Okay, so this one. Take this question here. How does a consumer's time preference for consumption affect the level of savings and consumption? Rather complicated expression there. Consumer's time preference for consumption. What are we talking about? What are we talking about? Oh, go ahead.
Depending on your time preference will depend on when you want to consume. So if you have a high time preference, you will be more inclined to consume immediately, so you will save less. Whereas if you have a low time preference, you will have to wait for consumption, so you will save more.
Okay. So the basic idea is that all things being equal, most people want to consume now, and if you want them to defer that consumption, you've got to provide some sort of incentive. And that desire to consume now varies from person to person. Some people it's very strong, some people it's very weak, and for these different people, you have to provide a different level of incentive, and that's what we call the interest rate. Yeah, did you have another point?
I was going to say, would that almost be like the elasticity of supply and economics? Because basically, for somebody who has a high preference, like a short time preference for consumption like that to consume immediately, it means they actually require a lot of incentive to loan that money or to save that money.
Yeah. Basically, if you have a strong desire to, consume now, and say we want them to save, then we have to provide a big incentive. Yeah. So it does vary from person to person. Some people save lots without much incentive, and some people need a lot of incentive to save. Okay, so did that one. I think we said the last one as well. So moving on. If you're doing Finance 201 or 205, you actually come across the idea of the time value of money. And the basic idea is quite simple, is that if you have $1 today, it's actually worth more than $1 in the future. And the question about, well, how much more is it worth now than it is if I got it in a year's time? That's the thing that eventually sets your interest rate. Now, on top of that, there's a whole lot of other stuff, and one of them is risk. And there's one is that when you lend money, there's a potential you might not get it back. And every time we strike a risk factor of any type, we have to figure out how much it's likely to cost us, and then we have to, in this case, build that into the interest rate we require to be compensated for that risk. Okay, I think we said all that. Any questions on that before we go to this loanable funds theory? Anyone had a question? You all happy? Okay. So loanable funds theory uses a standard model that you've hopefully learned in first year economics about supply and demand. There's some supply, there's some demand, and somewhere in there's a balance between those two, and that gives us what we call an equilibrium interest rate. So the supply, there's all sorts of different sources of supply, but there's three main sources. There's consumers, there's businesses, and there's government, and then there's a whole bunch of people who demand are usually exactly the same people in terms of groups. And somewhere between those two, there's a balance where the supply exactly equals the demand, and at that particular interest rate, that's what we call the equilibrium rate. So there's get a picture? Okay. So there's a group of them. These are the same ones. So let's draw this. Let's draw this. So the question, if the demand, let's turn this around. Let's turn this around. So turn this question around. So here's quantity down here, and in terms of what we're talking about, dollars, here's our interest rate up there. Let's say we change the level of the interest rate. So what should we do? We'll put the interest rate. Look, if the interest rate goes down, is the demand likely to go up or down? Interest rate goes down, demand goes up. And so in terms of quantity, if the interest rates go down, the demand for quantity goes, demand goes up. So that's why we draw when we draw these things, we tend to draw them as straight lines. There's no reason the B straight line could definitely be curved. As long as it doesn't double back on itself, it's fine. But that's why we put the demand curves going down. Basically, as the interest rate goes down, then it becomes cheaper to borrow. If you're a business, more projects are profitable. If you're a consumer, it becomes cheaper to borrow money to go spend, and so on. And so the demand, which is along here, this is if the interest rates go down, that demand goes up. Now, what if we do the supply? Okay, so here's our quantity in terms of dollars. There's the interest rate there. What happens to the supply? If the interest rate, say the interest rate goes down, what happens to the supply? It decreases. So we tend to draw the line the other way. Okay, basically goes the other way. So this is supply. Basically, this interest rate comes down. The quantity that people are willing to supply goes down. Because basically, if you think about, we were talking about an incentive to save. If we're dropping the interest rate, we're dropping that incentive, and fewer people respond. And because there's a whole bunch of different desires to save and abilities to save, it's simply, we draw that thing like a line. And so not everybody drops out at one time. Now, when you put the two together, if you put the two together, put a demand in there in the other way, then supposedly, in terms of our nice theory, this interest rate here, this is our equilibrium rate. And it's just the point at which the supply exactly equals demand. And so when we talked about the allocated function of the interest rate, this interest rate makes us allocate the money that has come in, because this supply is at this point, to the projects which are able to pay for it. And so a nice balance between the supply and demand gives us this thing we call the equilibrium rate. So let's move on. In this one here, the key measure that determines whether they can borrow or not is a thing called the net present value. Now, if you're doing Finance 201, you'll definitely come across this. They definitely cover this in 201. That's the key thing, which basically, what a net present value is, if you haven't met it already, you don't know what it is, it's basically, if I undertake this project as a business, will I become more wealthy as a result of it? Or will I be making myself poorer? And if the answer is I will become more wealthy, then it's net present value positive. If the answer to that question is no, I'm going to become poorer, then it's net present value negative. And that's the key measure from a business's point of view about whether they're going to borrow or not. Okay, we said the last point. Said all this stuff, I think. Yep. Now, in terms of supply, although technically this isn't actually a separate group, the foreign investors, often they are sort of lumped into a separate group. And because many countries don't actually have enough internal savings, the supply of funds from overseas is quite important, and for New Zealand that's definitely the case. We certainly do not save enough money in this country to meet all our borrowing needs, and so we bring in money from overseas. So there's that point there about, if we let the competitive market work as it should, then it'll bring the interest rate into equilibrium where the supply exactly equals demand. But as we showed with, where'd my graph go? Oh, this one here. It's not set once for all. It's something that's very dynamic, changing all the time. So as any fluctuation in supply or demand changes the interest rate. Yeah, do you have a question?
I was just looking at the textbook, the supply and demand illustration textbook. It was actually showing a curved supply curve in terms of basically the marginal cost of supplying funds was always increasing.
Well, it's comparatively straightforward. I'll get another bit of paper here. So the one that's in the textbook is the supply curve. There's your quantity in dollars there, and there's your interest rate up there. It looks like that. Well, basically the idea is that for whatever reason, that there's a certain amount of income in the economy, but people have to live, and so this point here, I'll just call it, there's some maximum savings that can actually occur in an economy, and so that's the point there. And basically, you can't just push the interest rate up and continue to get more and more supply because overall the supply is absolutely finite. And even for those who would like to save, as the amount that they save goes up, it becomes more difficult to save more. And so the reason they have that thing curved is that there is really, in terms of supply, there is some upper limit to supply. And so, what you need is the closer and closer you get to that line, the bigger increases in the incentive you need to actually get that bit. Okay, does that make sense to you?
Yeah, that's it.
Okay. Any other questions? Okay. Okay. So this is all the same thing in a bunch of nice diagrams. Now, in terms of supply, we have a few extra things here. If the governments are running surplus, essentially what they're doing is they are putting money back in, but typically how it comes into the system is that as the government debt comes up and expires, they often will pay that back at that point and they won't reissue. So that's how, if they've got running a surplus, that's how it actually gets in. Central banks can directly put money into the system. Essentially, they can increase the money supply as much as they like. But as we saw in this particular graph, if they get too carried away with shoving money into the system, you can get inflation, absolutely crazy rates of inflation, because that thing goes from, if you think that's Germany, this is a 1, that's 10 trillion, and that only took a few years to do that. So, although central banks have this power to generate money and put it in the system, they have to be very careful with it, because you can get some very adverse consequences if you put too much in there. Okay, so there's our equilibrium and all this stuff. Right. So let's get another bit of paper here and look at these ones. So we'll draw up our nice supply and demand curve. So there's our quantity. In our case, this is dollars. There's our interest rate. And there's our demand there. Make it times 0. And there's our supply at times 0. And there's our interest rate there. Okay. So there's the situation as it is now. So what happens to the interest rate? Okay, take the first one. The loanable funds goes up. What does that do? Which of those lines does it move? Which direction does it move it in? Yeah, go ahead. Okay, so it's going to move. Hang on, it's got the wrong one. Sorry, this one. So so if the supply increases, that shifts it over, and this is our supply now. So we increase the supply in there, and that has pushed the interest rate down. So the interest rate has gone down. Okay, so what happens if the supply decreases? Goes the other way, indeed. And so if the supply decreases, the whole thing moves over this way, and we get a line over here. Say we started at this point there, and then this would be supply at time 2, and then the interest rate time 2. So the interest rate would go up if supply dropped away. And so any shift in the supply, either up or down, will have a effect on the interest rate. So what if we take the other one, and we'll start moving the demand one around. Now, so draw another diagram here. Here's our quantity, in this case dollars. There's our interest rate up there. There's our demand. And then there's our supply. And then there's our interest rate there. So what if the demand for funds goes up? What happens? Go ahead. Okay, so the demand goes over this way and goes up. And so there actually isn't enough of the current interest rate. So the interest rate has to rise. That's fair comment, what you say. Now, one thing to notice about this, okay, so in this one, we shifted the supply line around, but we didn't move the demand line. In this one, we're moving the demand line, but we're not shifting the supply line. So in one sense, when you think about what's happening in terms of quantity, so this is where we are when we started, and this is where we started, ended with when the demand went up, is that we got extra supply. We got extra supply coming in, but it's simply because we changed the incentive, okay? And that is different to the first one where we actually moved the supply curve. So in one sense, we've simply put the incentive to save up, and we've been able to pull more supply in, whereas in this one, the supply itself has moved for other reasons, for reasons other than a change in incentives. So taking the bottom one there, what happens if the demand drops away? What happens? goes that way. Right. That's, yeah. Okay. Yeah. So there it is. So it goes this way. There's your new demand curve. If the demand drops away, call it demand 2, and then there's our equilibrium there, and so that drops down. Now, question. We have an interest rate here, 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 and on the other one, we have interest rates here, here, and here. Can I get them all on at one time? Almost. Not quite. Not quite. So there's an interest rate here, 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 and an interest rate here, here, and here. Okay? So 6 of them. Question. Which one of those, if any, is an equilibrium rate? All of them. Okay? And it's very important to understand the answer is all of them, but it's also very important to understand why the answer is all of them. And if you don't get it, please ask, come to office hours, send me an email or something. Because every year, every year I put some sort of question like that in either a test or an exam, I get lots of people say that the starting point, which is that one, that's an equilibrium rate, and they tell me the other two aren't. Go ahead. You gonna say they're idiots?
I'm wondering if this interest rate you're talking about the equilibrium interest rate is a risk-free interest rate of return?
No, this takes account of all risk factors, and we haven't actually said what market this was. But this interest rate, this equilibrium rate, whatever this market is, this takes account of every last interest rate factor that we have. So if this is a private sector security, liquidity, default risk, interest rate risk, this takes account of all of those. Now, if we were dealing with very short-term government securities, like, say, for example, in Australia, they issue, I think, a 30-day treasury bill. There's virtually no risk associated with that. So although it's an equilibrium rate, that probably would be used as a risk-free rate.
So from what you say instead, so this one is supposed to be the main feature.
Well, this is the basic idea. This applies pretty much in all markets. Now, if this was, say, a 30-year private sector bond, there's going to be a whole lot of risks in there. But we get an interest rate that's an equilibrium one, where the investors have calculated all this stuff around what this risk is, and they figured out what they want, and the supply balances the demand there. Now, if you take, a 30-day treasury bill from the government, there's a completely different set of risks in there, but the same idea applies. For, like in the government one, and with the 30-year corporate bond, usually there's a competitive process that sets that interest rate, and basically, there's a demand and there's supply, and wherever that interest rate balances, matches. And you can see it very clearly in the government tenders, because often they're oversubscribed, which means that more people have applied for government bonds than are available. And what they do when they apply is they put in, I want X numbers of dollars of bonds, and this is the interest rate I want for my bonds. And then when they, in our case, we've got an Office of Debt Management. It basically lines it up with the cheapest ones first, and it gets to a point where, they've got all the money the government needs, and that interest rate becomes the interest rate for the bond. And there's all these other people say, yes, I would loan you money if you paid me more, but because the demand, say they're issuing $500 million worth of bonds, and they got $2 billion worth of bids, they simply pick the cheap ones. And at that point, when they've got $500 million worth of offers, whatever that interest rate is, at that point, that becomes the interest rate for that issue. So that applies in any interest rate market. Does that answer your question? Okay. Right. So we'll run out of time. So we'll pick it up probably a little bit further on from this on Monday. If you want to ask any questions, be around for a while. Otherwise, we'll sort of be over here. Right. Pick it up at this point. What about it?
Is supply increase, supply decrease, and demand increase, demand decrease. That's correct.
Yeah. So